Great. Good morning, everyone. I am Jay Peabody, a partner at Partridge and Hahn, and we've got a great group of panelists today between PSNH and Waldron Rand, and we're going to break down and discuss the tax analysis of the One Big Beautiful Bill Act. Thank you guys for joining us today. We are going to probably do more presentation style in the beginning. We did open the questions box, so to the extent people have questions, and we would welcome them. If you can add those in the questions box, we will work through about 60 minutes of content, and then the last 15 minutes I'll be monitoring the questions throughout. I will pull out some of the more broad questions that have some substantive, broader appeal, and walk through those with our panelists. So we're excited for this. We've got over 200 attendees, which is great. Just a little bit of background. Most of us are fairly familiar at this point with the One Big Beautiful Bill Act. Also goes by the acronym OBBBA. So you've probably heard of that. It was passed into law by Donald Trump in July 4th, 2025. I'll call it sweeping and ambitious piece of tax legislation with extremely broad and far-reaching implications that does touch individuals, businesses, and certainly the broader economy. Despite I'll call it lighthearted nature of the name of the act itself, it is anything but lighthearted, and it does provide significant reform to corporate taxation, individual taxation rates, international provisions, which we are not going to be talking about in this particular webinar, and relevant compliance as well. So the goal today is to move past the headlines, any sound bites that we might have heard, keep it apolitical, and provide what I'll call a serious and substantial analysis of the various provisions of the bill, what's changed, what's left unchanged, and then the real world impacts of the act. So the way we've cut this up is, as I mentioned, 75 total minutes of webinar, 60 for presentation, 15 for questions. We will be sharing the slide deck after the presentation to all attendees. And at this point, what I'd like to do is just provide a quick intro of our panelists in the order in which the content will be presented. So we have Sharon Schaff, who is a shareholder at Waldron Rand. She'll be handling the individual tax implications of the act. We have Rick Lugash, who is a shareholder and managing partner of Waldron Rand. He is going to tackle the business-related provisions of the Tax Act. We have Russell Stein, who is a partner of mine at Partridge and Hahn. He's a corporate and tax partner. He is going to probably chime in a little bit on individual and business, but more specifically work through the opportunity zone implications of the act. Collectively, between our two firms, we have a lot of real estate clients, and we figured that would be an interesting topic area for a good portion of our attendees. We have Liz Manchester, who is my nonprofit partner. She's going to tackle the nonprofit provisions of the act. And lastly, but certainly not leastly, we have Beth Grossman, who is a shareholder at Waldron Rand, and she's going to handle the estate tax implications. So I would say with that, unless any of my fellow panelists want to chime in, I would hand the presentation off to Sharon and can dig in.
All right. Thank you, Jay. So we kind of already went over sort of what the agenda is for today. So the new tax law brings with it so many impactful provisions for individual taxpayers, but perhaps the most consequential change is actually what did not happen, which was the sunsetting of some key rules of the Tax Cut and Jobs Act. So by making the Tax Cut and Jobs Act rates, brackets, and some other critical elements permanent, the legislation preserves tax treatment that was at risk of expiring. So today we're also going to address some of the new provisions, but for many taxpayers, the biggest impact of this new law is really just going to be a sense of continuity. So the Tax Cut and Jobs Act rates and brackets are now made permanent. So that highest bracket stays at 37% instead of going back to 39.6%. And the highest bracket starts at 751,000 if you're filing jointly, rather than a lower start for that highest bracket of 615,000. There also, the TCJA had a much larger standard deduction, so that is preserved. The deduction that you'll receive now, even if you don't itemize, is about double what it would have been had this not been addressed in the law. The TCJA doubled the child tax credit, so that's been made permanent, and a slight bump up to $2,200 per child. That's subject to income phase out, starting at $200,000 if you're single, $400,000 joint. The TCJA also had dramatically increased the AMT exemption to address an issue where a lot of people who were not the intended targets of that minimum tax computation were getting hit with AMT. So the new higher exemption does stay, so that 137 is about 50,000 higher than if we had reversed back to the pre-TCJA levels. But in the new law, the phase outs of when you lose the benefit of that exemption happens a lot more quickly. So we do expect that starting in 2026, a lot of the higher income taxpayers may actually get stuck in AMT and be impacted by it. So there might be some planning around that. And then the really valuable QBI deduction was made permanent, which is really important to a lot of business owners. And that's something that Rick will talk about in more detail in a few minutes. So not all of the TCJA provisions were taxpayer favorable. There are certainly some unfavorable to taxpayer provisions that were now also made permanent. First, we have the elimination of the personal exemption, dependency exemption. So those are permanently gone in the new law. There is a new senior deduction, which we'll touch on in a minute. TCJA also had reduced the eligible mortgage on which you could deduct your mortgage interest from $1 million to $750,000. So now that limit is permanent. So you can only deduct interest that is attributable to $750,000 of your mortgage. Miscellaneous itemized deductions, which were removed by TCJA, they're gone permanently now. So those are things like tax prep fees, investment fees. The TCJA had kind of narrowed the scope of what you could deduct as a personal casualty loss. So that is now limited to federally and state declared disaster areas. Moving expense deduction is permanently suspended. And then another really important provision to small business taxpayers, which Rick will also go into more detail on in a minute, but this excess business loss limitation does stay. So in addition to the TCJA provisions that were made permanent, there are also numerous new provisions that are included in the bill. And first we'll take a look at those provisions that actually have income phase outs. So as I mentioned earlier, there's a new $6,000 senior deduction. So if you're 65 and older with an AGI of 75,000 single or 150,000 joint, you could benefit from a $6,000 deduction. This is fully phased out when you have an additional 100,000 of income. So if you are over 65, have 175,000 of AGI, file single, you don't get any benefit of the deduction. There was some talk about Social Security being exempt from tax. That didn't happen in the law, but this is sort of targeting the same demographic and trying to provide a benefit. There's also a new provision to incentivize the purchase of US-made cars. So there's a temporary deduction up to $10,000 of interest paid for new cars assembled in the US. Also has income phase outs, 100,000 single, 200,000 joint. The no tax on tips provision has gotten a lot of attention. So there is a temporary $25,000 deduction on qualified tips. That phases out at gross income of 150,000 single and 300,000 joint. And you can't play around with filing status choices in order to stay within the phase out, because if you are married, you must file jointly. There similarly is a temporary deduction for overtime pay. So if you're time and a half, this is just the half. It's only that premium portion, and it can be up to $12,500 if you're filing single and $25,000 joint. It has the same phase outs as the deduction for tips. So even though if it doesn't impact you personally, if you're an employer or a business owner, you're going to have to pay attention to this. First, you're going to have to report that overtime to the IRS, to your employees, so they can get benefit of the deduction. And there will be guidance issued on how employers have to do that. But in addition, it's going to just shift some of the economic decisions around overtime use and employee classification, because this is a significant amount of additional cash that is going in the pockets of these employees.
Sharon, if I can just jump in here, for certain states that have overtime regulations that are different than the Fair Labor Standards Act, this provision is going to cause a lot of issues in those states, such as in Rhode Island. So the federal exemption only applies to overtime related to the Fair Labor Standards Act. So if state requires other overtime, such as I believe Rhode Island requires mandatory overtime if you work on weekends for certain jobs, this exemption does not apply to that. So it's going to create significant reporting questions and administrative issues for employers, specifically in Rhode Island, but it could apply in other states as well.
Yeah, let me add to that a little bit too.
Yeah.
I think what's also going to be, and probably will complicate this particular issue is, and if you've been tracking it, you've probably seen it, and it's also state specific, is the misclassification issue. So the real tension that exists between independent contractors and employees. And it's something that's it's an ever-changing landscape, but I think it's going to be an even more and quicker ever-changing landscape based not entirely on the Tax Act, but I don't think it's going to slow things by all means.
Yeah, certainly. Yeah. So now let's just take a look at some of the new provisions that are not income dependent, that don't have phase outs. There's a new itemized deduction for eligible educators for their out-of-pocket costs that starts in 2026. So teachers with those out-of-pocket costs potentially could get a much larger benefit than they could before, when they were limited to $300 deduction. But starting in 2026, they're going to have to itemize to get any benefit at all. So some it might not help. And then Liz is going to talk about these in more detail, but charitable contributions have a pretty big change as well, with a new floor established and then a non-itemizer charitable contribution added. Then we've all heard a lot about the Trump account. So it's a tax deferred investment account, another way to do some long-term savings for your children. And the benefit is the tax deferral over time, but then also qualified withdrawals are taken out at capital gains rates and not at the ordinary income rate. Qualified withdrawals are things like education, buying a new house, investing in a small business. And the first contributions can be made, I believe, July 4th, 2026. You're limited to 5,000 of contributions. That has nothing to do with the child's income, their earned income. And those contributions can come from family members or from your employer. So the employer, actually, there's a $2,500 annual contribution that they can make that can be exempt from the employee's tax. So that's another benefit. And then for babies born between 25 and 28, as you've heard, the government is providing some seed funding, $1,000 to each of those accounts, and they're setting up those accounts as you get your Social Security number.
Hey, Sharon.
Yeah.
The $5,000, I believe that's in total from all sources. It
Correct.
can't be that each of your grandparents give 5,000.
Yeah.
Next thing you know,
No, you're right.
100,000.
Mhm.
5,000 in total.
Absolutely. And then you can't do that after they're 18. You can do it up till they're 18 years old. The new law also took away some provisions, largely just accelerating the elimination of several popular energy credits. So throughout the end of 25 and 26, these energy credits will be repealed. And then let's look at some provisions in the new law that were modified. So the SALT deduction cap gotten a lot of publicity. So as you know, under TCJA, you were limited, if you itemize your deductions, to taking only a total of $10,000 of a deduction on state, local, property taxes, excise taxes, that combination was limited to $10,000. And in the new law, it's up to $40,000 temporarily from 25 to 29. But that's only for taxpayers with up to 500,000 of modified adjusted gross income. And once your modified adjusted gross income hits 600,000, you're right back to that $10,000. So high income taxpayers, it's not really going to affect them on their personal income tax returns, but Beth will touch on later that those higher income taxpayers who have trusts, this may actually come into play and be a benefit. For taxpayers with less than 200,000 of income, the child and dependent care credit was modified and enhanced after 2025. Similarly, the adoption credit now has a refundable portion that also has income phase outs. And then for those in the top tax bracket, there's a new reduction in the benefit that you'll receive for your itemized deductions. So if you're in the 37% top tax bracket, the new reduction means that you're only going to get a 35% benefit for your itemized deductions. And this is in lieu of the return of what they call the PEAS limitation, which prior to TCJA reduced the high income taxpayers the benefit that they received or the amount of itemized deductions they could claim, and it could reduce it up to 80%. So while we think the 2% reduction will be less punitive than a return of the PEAS limitation, since taxpayers have had neither limitation for several years now, it's probably going to be an unpleasant surprise when that kicks in 2026. They doubled the amount of Section 529 funds that you could use for K-12 expenses from $10,000 to $20,000. So for families with kids in private school, this could be a helpful thing. Then, as we talked about, Russell is going to go into a lot more detail on the modifications to the Opportunity Zone tax credits. And finally, like one exciting enhancement is this changes to qualified small business stock. So the current law, so for stock acquired before July 4th, 2025, if you invest in a qualified small business, defined among other things as having 50 million or less in gross assets at the issuance of that stock, you potentially can hold that stock for 5 years and then exit with a $10 million gain tax-free. So under current law, you hold that stock for $10 million, no tax. For $10 million, you hold that stock for 5 years, no tax. You hold it for a couple days shy of 5 years, and you'll have $2.5 million of federal tax. So it's a big savings, but you really have to follow the provisions. The new law is a lot more forgiving and flexible. So there's a tiered system. 5 years, still 100%, but if it's 4 years, you get a 75% exclusion. If it's 3 years, you can exclude 50% of the gain. Also, they increase kind of the umbrella of companies that could qualify by taking that 50 million asset threshold and bumping it up to 75 million. And even the amount of gain that you could exclude went from 10 million to 15 million, which will be indexed for inflation. So a lot of opportunity here. And if you have stock that you're going to have much more than a $15 million gain, that's going to talk about how you can, multiply and do some planning with trust to multiply that exclusion. But this has always been part of an analysis with entity selection because this is only available for C corporation investments. So I think it's going to become more important to think about in the entity selection process. And it's also going to be planning consideration for employees. So if employees, whether they're making an 83B election or whether they're going to have an early exercise of their stock options to start the clock on that on that holding period. So this is enhanced enough. I think it's going to come into play and be some interesting planning opportunities.
Right. We've had a lot of conversations over the years of people with LLCs and asking if they should be converting to corporations, specifically to C corporations. And generally the answer often was not that it wasn't going to be beneficial for various reasons. Either their assets are too high or they're looking for an exit strategy within a year or two. The changes that have been implemented might cause those conversations to have better results now. That companies that are more than 50 million but under 75 million structured as an LLC may make sense to do the analysis to see if you want to convert to a corporation, particularly if you're going to have an exit strategy within 3 years or 4 years. It could also affect post-exit strategy planning. So some of exit strategies have you rolling over into an acquirer. Typically, those rollovers are into LLCs. It's possible with these enhancements, and depending on the value of the company, they may start doing rollovers into corporations so that your quote second bite of the apple when the purchaser sells the rollover shares could possibly be exempt from federal taxes. So there could be a lot more planning opportunities for businesses, both startups and existing businesses, because of the changes in these rules.
And before I turn it over to Rick, talk about the business, I just want to step back and sort of look at those key provisions that we talked about that we think are going to be the most impactful for high net worth individuals. So clearly the rates, the brackets, the AMT exemption, the fact that they won't revert back to pre-TCJA levels is a really important thing. That enhanced QSBS exclusion that we're talking about, that's going to be really interesting to plan around. The charitable contribution floor that Liz will talk about, those new itemized deduction limitations, getting a haircut on the benefit of your itemized deductions. And then these two provisions that Rick will address that will have significant impact for small businesses. And then I have this chart, I won't go over it here, but it'll be included in the handouts. And it just goes through the itemized deductions, the rules that were in place pre-TCJA, so what it might revert back to, the TCJA rules, and then the new rules, and when they're effective. And lastly, I know James said we're not talking about international, I'll just touch on it really quickly, but there are a lot of international tax provisions in the new law. But when you go through it, it's really just focusing on a few big buckets of taxpayers and not going to be that impactful to that many people. So there's lots of GILTI changes. That impacts US shareholders who own more than 10% in controlled foreign corporations. There's FDII changes. That generally impacts US corporations that have significant foreign sales. There's BEAT changes. Those impact very large multinational corporations. So for the most part, that's not going to impact a lot of the majority of taxpayers. There is this 1% excise tax that was introduced for cash transfers to foreign recipients. There are a lot of exemptions if it's done through a US bank or US credit card. So in most cases, it shouldn't impact people, but there's a little concern that, let's say you're a US citizen and your child's studying abroad for the year and you send them money, that it could unintentionally get caught up in this. So we just got to keep an eye out for the guidance as it's issued for this. So that is all I have, and I can send it over to Rick.
Yeah, thank you, Sharon.
Quickly, before we jump in, Sharon is absolutely right. There are a lot of international provisions in the Act, and Sharon does a good amount of work in that space. So she did sneak that in, and I knew she probably would, which is appropriate.
Yeah.
Rick, before you jump in, I know we've been touching on topics as we go. Does anybody have anything they want to add before we shift from the panel? And if not, Rick, you've got
No, I think I'm good.
you've got the floor.
All right, thank you.
You're welcome.
All right, good morning, everyone. All right, let's first talk about research and development cost. Back in the TCJA, I refer to the Jobs Act. There was a unknown provision in there, which nobody paid attention to, that said starting in 2022, companies had to start capitalizing research and development, where prior to that, you can expense it. And it was done to balance the budget so it can pass with a simple majority. But everybody assumed, including the politicians, that when it came to 2021, they passed another law and changed it. And there was a number of bills that came in, never happened. 2022 came along, and all of a sudden companies started to have to capitalize it. Big impact, large companies and small. And we've been doing that for 22, 23, and for those that already filed for 24, in 24. Well, after 5 years of saying they're going to change it, they finally did. And now you can expense it starting in 25, and you can actually go back and amend prior year's returns. If you're under 31 million in total receipts, you can go back and amend the corporate return, the S Corp or whatever, partnership or C Corp, and then you have to amend the personal returns if you want to do that, or they give you an option of just writing it all off, any unamortized balance in 25, or in certain cases, you may want to elect to split it over 2 years, but you have that option and you have to look at that. But it's definitely finally came through after 5 or 6 years. Another one is what Sharon referred to as qualified business income. That also came in when, in the Jobs Act, they lowered the corporate rate from 35 to 21, and the individual rate was still at 37 under that act. It's too much of a spread. So they wanted to, if you were an S corp or partnership, to come up with lowering your rate. So instead of coming up with a new tax rate applicable to business income, they came up with this deduction, which you could spend a day working through the rules. But effectively what it did is it allowed a deduction for all businesses, for the most part, other than C Corps, to lower the rate from 37% down to 29.6. That was set to expire next year. So that would have been a 20% increase in everybody's tax rate. Forget the 37 to 39.6 that Sharon referred to. But that has now permanently been made into law until they change it, the next administration or whatever. And they've also increased some phase-out limitations. Some businesses, like a consulting or an accounting firm, you lose the benefit over a certain amount of income, somewhere around 490,000, I think it is. But larger businesses above that still get it. You have to have subject limitations based on wages, 50% of wages, et cetera. Very complicated, but nevertheless, that is staying in place. The excess business loss limitation that Sharon referred to, that was something that was put in that basically, in short, says that if you have $1 million of interest income, for example, or a capital gain from a stock, and you had $1 million loss from a business, under the old rules, you offset the two, you pay no tax, it's great. They actually, when they put it into law, said we can only offset up to 500,000 of that loss against non-business income, interest, dividends, capital gains. And you'd still have to pay the tax on the other 500,000 above that. That was, going to set to expire, but that now is permanent. That threshold is about 540 now, indexed for inflation. Anything you don't use because of this limitation, which is called this excess business loss, gets carried forward and then becomes part of a net operating loss in the subsequent year, which you could offset up to 80% of your income, and you start all over again with a new limitation in the next year. Just complicates the return and definitely limits the benefit of these business losses. If you have business income from one entity and a business loss, you can offset them, no issue. It's the net business loss that you can't use. 160. Go ahead, Jay.
Quickly before you jump into the next topic, before on the R&D tax credits, the deduction. So my understanding as well is that not only did the new expense rules make for more eligibility, but didn't they also really almost redefine or better define what is research and development? So they made it a little more aligned with innovation, adding software implementation development. So it's really much more expansive in the sense that businesses should be thinking about their R&D spend, because what might otherwise have been eligible for a credit, what might not have been eligible for it may be now. Is that correct?
That is correct. And actually, there's a lot more reporting requirements to actually take that credit. In the past, you would just go back and come up with an amount. Now they do want a lot more support, albeit they enhanced it, but there's more support required. That's why in a lot of cases, you do get a study done to support it.
And Rick, I think you had mentioned this, but just to point out, on the foreign side, this is only U.S. R&D. So
That's correct.
anything that's outside the US, any R&D that you do outside the US, it still has, it has the 15 years. It also impacts if you have a subsidiary that does R&D in the US, it could increase your GILTI inclusion, and it has a few different adverse tax consequences. So you just gotta be careful of that.
Yeah.
And there's some talk that even if you just outsource to a domestic company and that domestic company hires people who are outside the US, that you might not be eligible.
By the way, you do have the option of still amortizing those costs if for some reason it made sense. You have that option, but the default is you can expense it. That's a big change. It impacted a lot of our clients. 163J was a provision in the Jobs Act that basically limited the amount of interest expense that you can deduct. When it first came out, it basically said you can take your net income, add back depreciation, add back interest. Fact that we take 30% of that number, that was the limitation. It affected some businesses, but not all, because depreciation did not factor in. But in the law, starting, I believe, in 22, you had to start basically taking out depreciation as an expense. So now your net income drops down 30% of a lower number. Some cases that interest expense was limited even further. You don't lose it. Again, it gets carried forward, but it does limit in that year. It affects a lot of real estate, although there are certain elections you can make giving up some things, but getting around this limitation. Now, going forward, although it is still there, they basically are allowing you to add back depreciation so you don't have to subtract that, so you get a higher income. That is permanent as well. Another change, little subtle change, employer provided meals. If you have a company that provides meals to its employees for convenience purposes, in the past, that was deductible. Now it is not deductible at all, not even 50%, which is still the case with certain business meals, but employer meals are not deductible at all. So for those of my team members that are watching this webinar for tax season, we're going to go back to pizza and salads and no longer the gourmet meals that we've had. Just kidding. All right, another big impact is depreciation. All right, back in the Jobs Act, Sharon referred to it as the TCJA Jobs Act for me. Bonus depreciation was introduced, and that was that certain property that basically had a useful life of less than 20 years, that would exclude a building, but would include land improvements, personal property, and if you had a study done and can support parts of the building that would qualify as a shorter life, you can get a sizable upfront deduction. That was 100%, and it stayed that way, again, I think until 22, and they put these provisions in to balance the budget. So they, because they look over a 10-year period when they write these bills and they have to make the inflows and outflows balance. So they say, okay, well, after 3 years, we're going to lower that 100% down by 20% per year. So that bonus depreciation, which we refer to as 100%, for 2025 was 40%. For 26 was going to be 20, and then it was going to expire after that. They now made it permanent for any assets acquired after January 19th, 25. And just, they obviously have a provision in there, like they always do, that says if you had, for example, a building that you had under agreement in December, but you don't close on it until January 20th, you don't qualify for the new rules. You qualify under the old rules, so you'll get 40%. And then the rest of what you don't take is subject to the normal depreciation rules. That has not changed. Usually there's some provision, we'll get some guidance if you're building something and you started, but you only spent 4% of the hard costs. Sometimes they put a provision that if it's not more than 10%, it's considered after, but we're gonna have to wait for guidance on that. If you're having a specialized machinery built and you're having it done and it's being built for you and you started in 24, but you acquire it in 25, it probably would not qualify because you had a binding agreement. So they usually will provide guidance on that aspect of it. 179, which is another way to write off property up front. That threshold, which was at $1,250,000, is now doubled to 2.5 million of equipment effectively that you can write off, plus some other assets. But there was phase outs that if you spent more than a certain amount, large amounts, you wouldn't get the benefit. Albeit you can still maybe bonus it under whatever provision it was in that year, 40, 60, or 80% or 100. That phase out now is increased to $4 million. Obviously, you have to make a decision whether you do 179, whether you do bonus. There are implications. Trust may not get the benefit of 179. Some states, a lot of states do not file bonus, but they do follow 179. So all of that factors in. And obviously, there's going to be some discussions on the states if they don't adopt the code as it's written now, but adopt it as of a certain date. Theoretically, you could have different depreciation for different states, different bonus depreciation amounts. I like to believe that eventually everybody will come aligned to either accept bonus or not. But we'll wait to see over the next few months. There's one new provision. Just going to point it out that if you're actually building a plant to do manufacture something, it's called qualified production property, but in essence, it's a manufacturing plant. They want you to invest in that you can actually write off the portion of the building that's applicable, not just the equipment and stuff that would be less than 20 years, but I believe you can actually write off the actual cost of that building. But you can't include, if the building houses accounting, sales, HR, I don't know how you're going to do this, but you have to separate the cost, and only the portion that's applicable to production would be written off. One thing Sharon alluded to, they repealed a lot of credits, wind and solar being one. When they had those credits, there was a very specific provision that said if you bought solar panels, it was a 5-year life. Well, they repealed that provision. So now you have to figure out, and quite honestly, there's a lot of gray area as to what the life is. Some say it's 20 years now on solar panels. There'll probably be some guidance, but it's no longer 5. But that now is gone. And also it's, I think, as we said, the wind and solar credits phase out in 27. There's some transition rules in there. But that whole idea of solar, wind, the 30% solar credits, that is going to be gone, along with, some on the cars that Sharon mentioned, that's going away. Also, there's something that was called a 179D. I think, Sharon, that's the next one up, I believe. I missed it. Okay, but anyway, 179D was a deduction for energy efficient commercial buildings. That now is repealed as well. All right, a couple of
Rick, is it safe to say, so between R&D and the bonus depreciation, in each case, you need, special reporting. You need studies done based on now changing an asset qualification, depreciation relative to in-service dates.
Absolutely.
And I would say multi-state, operators have to also think about state implications, right? So and these aren't things that that we should be advising our clients to treat lightly. These are very important and detail driven factual determinations.
Absolutely. And it's even more important now than it ever was. For example, you're talking about these cost segregation studies that some companies do. No, we don't do them, but there are companies that do them, which maximize that depreciation amount. Depending on the size of the building, whether it's worth to do it, but in a lot more cases now with 100%, it was getting to the point when it was 100%, everyone did it, 80% worthwhile. When it gets down to 60-40, you're saying, is it really worth it or not? Usually is, but it was a, sort of a tougher decision. Now when it's back to 100, definitely. And R&D is the same thing. If you had to capitalize the cost, you didn't really get the benefit, but now when you can expense it and get a credit, Obviously, there's some interacting adjustments you got to make when you get the credit and then the expense, but nevertheless, if you have it, it's a big benefit that the companies get. And as Jay said before, it applies to a lot of companies that you would think it would not normally apply to.
Great.
All right, on reporting, they've actually reversed course. You know, the IRS has over the years have always increased the reporting requirements. They've now, on a couple of things, made it a little bit easier. These forms like restaurants would get was a 1099-K from credit card companies that would give you month by month as the amount of money they paid you on credit cards. You know, the IRS was hoping to match it up, but it never matched up to the tax return because there's cash involved, whatever. That's now away, except for very few transactions, which doesn't apply to anybody on this call. The big change is for 1099, effectively NEC, non-employee comp. That threshold of $600, if check back, has been in existence for 70 years, never adjusted for inflation. If you paid anybody $600 from a trade or business, used to be on a 1099 miscellaneous, now a NEC, but that had to be reported. They finally, even though they've talked about this for years, upped that threshold to $2,000 starting next year, I believe. And that will be indexed for inflation going forward. All right, that's all I really have, the major implications. Jay, do you want to?
No, that's great. No, that's terrific. But before we shift into opportunity zones, I know I said I was going to handle questions at the end. One did come in. I just wanted to manage it now. It said, will you be having a separate international tax webinar before long? We didn't intend to. And I know that Sharon has some appendices slides at the back end related to international. So just time dependent, we can maybe touch on that before we jump into other questions to the extent that they come in. I only have one right now, so we do have some extra time. So I would say with that, let's flip to opportunity zones, and if we have a little time at the end, we can touch on some international items.
Okay, thanks, Jay. So opportunity zones were enacted in the code in the 2017 legislation. Basically, they were put in to encourage investments in economically distressed areas to allow taxpayers who had capital gain from one source, such as a sale of stock, to invest that capital gain into something called a qualified opportunity fund, a QOF, have that QOF invest in an area and with the intent of building up the economy in the area. So you saw a lot of real estate plays going into opportunity zones. The current law before OBBBA basically had the current opportunity zones, which are based on census tracts. They all expire at the end of 2026. So under the current law, after 2026, you couldn't make any more opportunity zone investments. The investments you already had would still continue at least until 2047 under the current law. So if you currently have investments in opportunity zones, nothing in this new law will affect those investments. You still need to hold on to them for 10 years. On December 31st, 2026, any gains that you had deferred by investing in a QOF will automatically be recognized, so you'll have to report them on your tax returns. What the new law does is it basically makes the concept or the tax credit and the tax benefit from opportunity zones permanent. So it doesn't expire after December 31st, 2026. It sort of starts again, and it starts again every 10 years. So starting in July of 2026, each state has to nominate certain tracts to be eligible for opportunity zones, or to be classified as opportunity zones by the IRS. The next slide, I'll get into what is required to be classifications, but for now, just remember that the states have to nominate it starting in July of 2026. And then the new designations will start on January 1st, 2027. It's sort of the same rules. You have to have what's called an eligible capital gain that's invested in an opportunity zone fund, a QOF. If you do that, then the gain that you invested, you don't have to pay taxes on that gain for 5 years. This is slightly different from the current rules. The current rules said you didn't have to pay gain until 2026, the end of 2026. So it was a fixed period. What the new rules do is now it's a rolling period. Once you invest in the fund, then you don't have to pay tax on those gains for 5 years. So if you invest in 2028, you don't have to pay taxes on the gain that you invested until 2033, 5 years after the investment. So long as you hold on to the investment for 5 years, you're going to get a 10% haircut in the gain. Technically, it's a basis step up, but the effect is that the gain that you deferred, you'll only be taxed on 90% of it once that 5-year period comes up. If you hold on to the investment for at least 10 years, then any appreciation in the investment is going to be tax-free, at least on the federal level. You can't hold on to it for more than 30 years. So the provisions more or less expire after 30 years. There used to be a 2047 hard date saying you had to sell the property by 2047 or you want to get the benefit. That's taken out of the code for new investments. It's still, I think it still applies to the old investments, but for anything invested after January 1st, 2027, you just need to sell it within 30 years. And there's also some new reporting requirements in the code. The fund is required to report more information to both the IRS and its investors, including the value of all its investments in and out of opportunity zones, and as well as how many full-time employees are involved in the business, either at the fund level or at the business level. Now, the opportunity zone credits are not contingent on any employment. There's other tax credits that are contingent upon employment, and there's a lot of local tax credits that are contingent upon employment. But technically, the opportunity zones are not contingent on employment. You have to have a business, and it can be a real estate business, but you don't necessarily have to employ anyone to be eligible for these credits. So the question is, why are they asking it? And whether or not there's going to be some regulation somewhere down the line that may have some sort of employment component to it. But as of now, there is no employment component. There's also no new regulations. So as what happened in 2017, when the regulations eventually come out, the rules may be further changed or modified. So the designations for new opportunity zones are going to be slightly more strict than the past designations. The current opportunity zones were more or less based on what's called the new markets tax credit definition of low-income community, but it was also based on old census. I think it was either based on the 2000 census or the 2010 census. So you had some opportunity zones that may have been in low-income areas or high poverty rate areas 10, 15 years ago that are no longer in those areas. So you had certain opportunity zones in places like Newport, Rhode Island, which you wouldn't think ordinarily of being an economic depressed area. They're tightening up those definitions more so that in order to qualify as a low-income area, generally has to have a poverty rate of at least 20% or a median family income rate not exceeding 80% of the state or the state or the metropolitan area median family income. That's the current rules. Starting in 2027, the family income test drops to 70%, and the poverty test is what's called what is being called an anti-gentrification trigger is being added to the 20% poverty test, that they look to make sure it's not more than 125%, that the income is not more than 125% of the applicable median family income of either the state or the metropolitan area. Another change is there was a contiguous tract rule in the current code that has been repealed. So certain opportunity zones also included, in certain circumstances, areas that were right outside the zone. That's no longer in the code. So the investments really have to be only in the opportunity zones. And in the current code, any low-income community in Puerto Rico was considered an opportunity zone. That provision was repealed, so it just defaults to the standard rules that the area has to have family income test at 70% and poverty rate of at least 20%.
Just to chime in quickly, you mentioned it, but just a point of clarification. So this applies to opportunity zone businesses and we'll call it opportunity zone real estate plays. And I think a lot of people saw it in the real estate place space, but these are for businesses as well. And then just to also mention the data point was, it was the 2010 census data that was used for the original designation. So my sense is, I've read a little bit about this as well, is that, they're trying to not only keep the opportunity zone investment, because it's a really solid thing for communities. They're just trying to tighten it up a little bit based on, I would say, some scrutiny around abusive practices when they did opportunity zones initially. So I think the intention's the same. It's just tightening up, making a little stricter the application. So just a point I wanted to make.
And you can, the point about real estate versus business, you can actually have two opportunity zone investments in the same property. So if you think of a residential apartment building with retail on the ground floor, the real estate could be its own qualified opportunity zone business. And the restaurants or the retail on the first floor can be a separate opportunity zone business. They're still under the same rules that you have to do what's called substantial improvement, but there's ways to sort of leverage what's out there into multiple types of investments. Now there's also a new type of opportunity zone called a qualified rural opportunity fund. These are opportunity zone investments, so the same rules appear to apply. You have to have some sort of QOF. It has to be in a designated area. But if that designated area is a qualified rural area, then the benefits are better for the taxpayer. So the first bullet is the 90% asset test, which is a test that's been around since the regulations came out back in 2017. The 90% good asset test requires 90% of the assets to be invested in the rural areas. Rural areas are defined as any area other than a city or a town with a population greater than 50,000 people, and any urbanized area contiguous and adjacent to a city greater than 50,000 people. So if you're less than 50,000 people and not attached to a city with more than 50,000 people, it's defined as a rural area. The tax benefits are, instead of that 10% exclusion from gain you get after 5 years, you get a 30% exclusion. So more tax, there's a greater exclusion from current capital gains if you invest in one of these rural opportunity funds. It's also easier to meet one of the requirements of the opportunity funds. The substantial improvement requirement generally requires you to put in at least 100% of the tax basis of the property into improvements in order to qualify as a good asset and a good QOF. The rural opportunity funds only require you to put in 50%. So there's lower capital that's going to be required in order to qualify as these funds. One of the types of businesses I was thinking that can really benefit from this is the self-storage industries. You see a lot of self-storage industries out in rural areas. And if it's in the zone, it could be a good opportunity for them to take advantage of this type of program.
That's great. So Russell, I've already gotten a question on the expanded impact for rural opportunity funds. And the question I was asked was, what happens if we are not entirely within the zone? And the answer is that the property has to be entirely in the new zone designation. It can't be, a portion of the property to get that better exemption.
Yes,
Yeah, so
probably.
it's
You have to meet the 90% test.
yeah, it is. And I was asked it in real time
Yep.
within the last week, so I did dig in and research
Yep.
it. The other question, and this is worth mentioning in real time, another tax professional asked, presumably you have to meet the normal OZ zone rules first, then the next test would be rural. Is that correct?
Yes, other than the substantial improvement.
Okay.
So the substantial improvement modifies the normal rules. So you need to have a quaff, you need to hit the 90% good asset test, and you need to have eligible capital gain going into it. Now, there might be regulations that would change that, but the way I'm reading it now is it modifies qualified opportunity funds and qualified opportunity business property. So you have to meet those rules with these exceptions.
Russell, I think just in general speaking, when they put these laws in place at the TCJA, the idea was you just didn't buy a building. As Russell said, you had to improve it. So they want you to buy it and then spend at least equal to what you bought it for, to improve it. That was the whole idea, to get people to invest, not just to buy a building and leave it the way it is. And that's where that substantial improvement requirement comes from conceptually.
Correct.
And there's all types of rules around it, how much time it takes to do it, and all of that, which we'll get into here.
Okay. Russell, we good?
We're good, although there's a comment about someone's hair. I don't know if it's my hair that looks good or your hair that looks good.
Yeah, I'm not sure.
No.
It can't be yours, but
Yeah.
that said,
It's not mine, I can tell you that.
before we shift to nonprofits and estate tax issues, we have about 15 minutes, which I think we're doing fine on time. Question quickly, Rick, to you. And I know I'm breaking every rule that I applied, but sometimes that's worth doing here. So the question was on the 1099 reporting requirement. So it's a simple question. Increases to 2,000 was 600. It says starting in 2026. Question was, is it 1099s issued in 2026, meaning effective for 2025, or is it for 2025 issued 1099s?
I believe that it is for 1099s. What was that, Sharon?
No, I believe it is the 2025 stays as is, and then the things paid in 26 will have
26, correct.
We'll
That's
double
my
check, but
understanding.
I believe that's what it is.
Okay.
So
great.
does that mean we're not going to be getting 1099s from Ticketmaster anymore? But it
Correct.
doesn't change if we're supposed to report something for tax purposes, it doesn't change those rules.
That is correct. Just because you don't receive it, you still got to report it.
Okay.
And you can't say as an excuse, well, I didn't get a 1099. You got to report it. I forgot to mention that. Thank you, Bill.
Great. Okay, with that, I'm going to pass the mic to Liz Manchester on our team to walk through nonprofits and tax exempts.
Thanks, Jay. I just wanted to start off with highlighting a couple of provisions that weren't included in the final act, because I've been getting some questions about this, and people in the tax exempt community were watching a couple of provisions closely that were in prior iterations of the bill. So a couple of things that weren't included was the enhanced ability to revoke tax exempt status for certain nonprofit organizations deemed to be supporting terrorism. So that was not in the final act, and also increased taxation for private foundations related to net investment income or excise tax, also not included in the final act. So there were no changes to private foundation taxation. What was included were changes to corporate giving limits. So the act introduced a 1% floor on the deductibility for charitable contributions made by corporations, meaning only when the amount of charitable contributions exceed 1% of taxable income can corporations then take a deduction. The maximum deductibility still remains at 10% of taxable income. That didn't change. The thought behind this was perhaps this would encourage larger gifts for businesses to get over this 1% hump to get the deduction. Some thoughts in the charitable giving community is this could actually quell giving from smaller and mid-sized companies that might not have the ability to reach this 1% floor provision. And they then might be looking to alternate ways to invest in the community, whether that be through community service. So it remains to be seen, of course, what the effect of this 1% floor will be. I think what will certainly happen is in conjunction with that reevaluation of giving strategies, we might see an impact and an increase to corporate donor advised funds, where a corporation might make a large gift in any given year to exceed the 1% floor. But then as donor advised funds go, might have the ability then to parse out and make the decision related to the use of that donor advised fund in subsequent years. And of course, we're still waiting on the final regulations to be enacted for donor advised funds. Those have been proposed and been kicking around for years. I'm not sure when or if they will be adopted. They still remain largely unregulated, but I think that will be a practical effect of this new corporate giving floor. Moving on to excise tax for highly compensated nonprofit employees. A version of this provision did exist prior to this act with the TCJA. There was a 21% excise tax on highly compensated tax-exempt employees for those making more than $1 million. It was previously generally capped at the 5 highest paid employee limit, but the new definition for covered employees expands that to any employee making over $1 million, not necessarily your top 5 highest paid employees. So I think a practical effect of this will be certainly nonprofits looking at their executive compensation policies, thinking at perhaps capping that $1 million payment in any given year, or thinking of creative ways to institute payments. This does include parachute and separation payments as well for former employees. And if there are subsidiaries controlled by a tax-exempt organization, that would also be included in the calculation of the $1 million. So I think we'll certainly have nonprofits looking quite closely at if they're meeting that reasonableness test for executive salaries, or this might enhance scrutiny for highly compensated employees to avoid any excess benefit transaction scrutiny. Next slide. Okay, so college and university endowment taxes. I'm sure many of you probably heard about this as the act was going through. This tax did exist prior to the institution of the One Big Beautiful Bill Act at a flat 1.4% tax. And prior to this act, it was applicable to institutions with individual tuition paying students of 3,000 or more. So what we've seen in terms of a change is a new tiered taxation model of between 500,000 and 750,000 of a student adjusted endowment. And that's calculated in looking at the value of assets divided by the number of students, would be faced with a 1.4% tax, 750,000 to 2 million, taxed at 4%, escalating as high as 8% for highly endowed institutions exceeding $2 million. I think here we'll be seeing organizations looking at their approaches to donors, and maybe donors thinking more thoughtfully about if they're going to enhance endowments for those larger institutions that might have face these certainly significant taxes. Also, I just want to note, because the size of the institution has changed. For the institution size now is applicable to 3,000 individual paying students versus 500 in the prior act. I don't know if I said that correctly. So the smaller institutions that have smaller enrolled students won't be subject to this tax. But again, the higher rates might offset that certainly. Then an interesting provision that's been talked about a lot and has some excited in the tax exempt space. And I think a lot of the detail related to this tax credit, we're anxiously awaiting regulations, of course, at some point. And I think the detail pertaining to this tax credit for donations to scholarship granting organizations will be key. But let's go over it at a high level. The legislation introduced a non-refundable tax credit for up to $1,700 per individual for contributions to state-approved scholarship granting organizations, or SGOs as they're referred to. This credit is effective December 31, 2026. The SGOs must be a Section 501c3 tax-exempt organization, and the use of the funds must be for elementary or secondary education expenses at private or religious schools. The key provision here is it requires state voluntary participation. Some states already do have this type of program and receive state tax credits. But again, there is the notion that states have to opt into this program. And the thinking behind this, and obviously those that have been talking about it, are stating this will expand school choice by incentivizing K through 12 privatization of education. And I think we also saw some of that with the enhanced use of 529 funds in this act that Sharon already went over, and whether this is in essence allowing for a voucher system to privatize education. There are some specific income requirements for the type of student that can benefit from this fund. So I think, again, the regulations will point to a lot more detail in terms of who the SGOs are, how this will work in tandem with states. There's also been some thought, if your state does not opt in to this tax credit program, if you live in Rhode Island, for example, and Rhode Island does not opt in, you could still make a gift if Massachusetts opts in to one of their SGOs and receive the tax credit. But again, I think the regulations will paint a lot more detail in that regard. Okay, and as Sharon alluded to, changes with itemized charitable deductions for individuals. So similar to that corporate floor, we now have the introduction of a floor for individuals equal to 0.5% of their contribution base to be able to receive the itemized income tax deduction related to charitable gifts. And as Sharon already described, there's some caps and compression of those in the highest income tax rate, basically getting 35 cents on the dollar rather than 37 cents for your itemized charitable income tax deductions. Again, perhaps the thinking was this floor would incentivize larger gifts to get over the 0.5%. I think like the corporate DAFs, I think we'll see an increase in individual DAFs in some cases to, again, overcome the floor and allow for larger gifts in any given year and parse out decisions in later years. With that, we also saw the benefit of a universal charitable deduction. This has really been pushed for and lobbied for in the charitable space for many years. We saw a small universal charitable deduction come to light during COVID times of, I think, $300. But there is a permanent universal charitable deduction under this act, up to $1,000 for individuals and $2,000 on joint returns. So even if you take the standard deduction, you're able to take this charitable deduction in tandem should you make charitable gifts. And the last thing, there was a permanency of the 60% availability to take up to 60% compared to your adjusted gross income for cash gifts made to public charities. And again, that's been sort of annualized on an ad hoc basis. Initially was an increase from 50 to 60% during COVID times. So again, this is a beneficial thing for charities and charitable giving. And that's all we had for nonprofits.
That's great. Appreciate that, Liz. And just to update the group, my colleague Russell, because he's an overachiever, is answering questions in the chat box in real time. So I know that content is as important as answering those questions. So I'd like to keep moving with content, and some of those questions are being answered to the extent that they're not. I think the slide deck or absolutely the post panel will have our contact information too, so you can always reach out to us. But with that, I'm going to ask Beth to update us on estate tax changes, which is a great way to round out everything we've talked about so far. And I am very certain that this thing isn't going to sunset at 11:45 sharp. So let's work through the content, and then we can. I'll just do just a quick closing remarks.
Great, thanks, Jay. So I'm talking about estate tax changes and some interesting tax planning opportunities specifically that are going to be coming up with non-grantor trusts. So just to kind of refresh on where we are currently, individuals have a $13.99 million lifetime estate and gift exemption, as well as a $13.99 million generation skipping or GST tax exemption under the Tax Cuts and Jobs Act on 2025 numbers. But those amounts were scheduled to sunset at the end of the year, and we're going to revert to $5 million per person with an inflationary adjustment. So now under this new act, we're looking at permanent increases to the exemptions with inflationary adjustments starting in 2026. That would include a $15 million lifetime estate and gift exemption per person, or 30 million combined for married couples, as well as a $15 million GST exemption per individual. So obviously very welcome changes, having those permanent increases. In terms of what that means, of course, it gives us a lot greater certainty from an estate tax planning standpoint and gifting standpoint. I think some people might perceive that as having a lesser sense of urgency for gifting, given the higher permanent exemptions, but we should be keeping in mind, are these increased exemptions actually going to remain permanent under future administration? And keeping in mind also that gifting strategies definitely still remain relevant, even with these higher permanent exemptions, where gifting is still very relevant for removing future appreciation on appreciating assets from the estate if you can gift them at lower values currently, or also keeping in mind, even if now with these higher permanent exemptions going into place, that we're still very much aware of state level estate tax minimization that may need to still be planned for example, for Massachusetts having still a $2 million estate exemption. So gifting still very much relevant there. But what we're definitely going to see is more of I'd say an increasing shift to the use of non-grantor trusts and planning with those types of trusts for income tax planning purposes, to really take advantage of some of these new benefits under the new act. And Sharon had kind of alluded to this a little bit earlier, so I'll speak to a couple of examples. One definitely being the increased SALT deduction cap, where essentially each non-grantor trust is its own separate tax-paying entity, so it can claim its own SALT deduction up to the annual cap. So what we're looking at is probably for high net worth individuals that are in high tax states or that have maybe a lot of real estate with high property taxes. They would potentially want to fund one or more non-grantor trusts to be able to leverage that increased SALT deduction. And you can see very quickly that a $40,000 deduction per trust, that if you're using multiple non-grantor trusts to leverage that can really yield some very significant savings. And similarly, we could see the same type of planning done with the QSBS planning, where if someone gifts QSBS stock to a non-grantor trust, then that trust can potentially qualify for its own $15 million exclusion. I mean, I'll say transferring the QSBS stock to non-grantor trust was already a really great strategy to get that extra exclusion. But now, given the shorter holding periods and the increased exclusion amounts, it becomes an even more compelling planning strategy. So I think we're going to definitely see a lot more of this in the future, and like a potential, like we're calling it a stacking of benefits by using multiple non-grantor trusts to really leverage these benefits even further. I did want to just point out really quickly that there is a caveat to that, that if you are going to be using multiple non-grantor trusts, that obviously that can be an area of abuse for tax purposes. So when new trusts are set up, it will be very important that they're drafted to be clear that they have a legitimate purpose other than just tax minimization. So that'll definitely, I think, be something really relevant in the planning phase. And I think one other thing to point out would be obviously for new trusts being set up, the trend is probably going to be leaning more towards setting them up as non-grantor trusts, whereas in more recent years, the trend has oftentimes been more on the side of a defective grantor trust where assets are put into these trusts to get it out of the estate for estate tax purposes, but it's still taxed to the grantor for income tax purposes. So for folks who have existing defective grantor trusts, now is probably a good time to dust those off and take a closer look, because typically those will have provisions in them, like a toggle provision where you can actually turn off defective status and cause it to be then converted to a non-grantor trust, or otherwise just releasing the certain grantor powers in there that would then cause it to be treated as a non-grantor trust. And that might be something to pursue or at least evaluate in the existing trust to see if it might be worth looking at to take advantage of some of these newer tax benefits under the new act.
Great. Beth, thanks for that.
Thank you.
So as I mentioned before, we have been answering the questions in real time. So I don't need to pull questions, as I said I would, from the chat and ask the group at large. We have also hit 11:48, which is 3 minutes past our allotted time for purposes of our audience expectations. So I think with that, unless anybody on the panel wants to add anything, which I'll offer that if you'd like to. But if hearing none, first of all, thank you guys for your time and certainly expertise. I'm lucky to have you as colleagues and friends, so I appreciate it. So Russell, Liz, Rick, Sharon, and Beth, thank you guys very, very much. Sarah and Laura from our teams that helped in the background putting this together. Appreciate their help and support, and then certainly the audience for not only attending. We've had a little bit of a drop off, but really minor. We got 134 people still on here listening, so I think we've clearly captured what we wanted to here. But our audience members for attending and asking questions, so and we appreciate that. As I mentioned, we will be sending out something to all the attendees with both the slide deck, and we'll provide some contact information. So to the extent you have nuanced questions for any of us, please feel to reach out, and I'm sure we can handle those. So I would say with that, I hope everyone has a great end of the day on Thursday, end of the week, and we appreciate everybody's attending. Thank you.